Welcome again, everyone. This webinar is brought to you by Ohio's Employee-Owned Network, part of the Ohio Employee Ownership Center at Kent State University in Kent, Ohio. We're a nonprofit training and outreach organization located right on the campus of Kent State, and we focus on ESOP transitions and training. Today we have Dave Gustafson of Apple Growth Partners in Cleveland. Those of you that know Dave know he has a wealth of experience in ESOP valuations, but today a little different twist. The topic is an appraiser's perspective on acquisitions. Dave, take it away.
Okay. As Jay mentioned, I'm Dave Gustafson. I'm the ESOP practice principal at Apple Growth Partners. We primarily work with about 60 ESOP companies on valuations and work with a handful of employee-owned groups and owners every year doing ESOP transactions and transitioning businesses. This is kind of fun. We've been seeing a lot of M&A activity the last few years. I guess I'll say primarily with our 100% ESOP clients that are finding they have the wherewithal to buy and finding it's an interesting part of their business strategy to start buying clients. And so we're starting to see some interesting trends. We're starting to learn a few things and help clients. And so when Jay originally came to me with the topic about, it started as a, how are making acquisitions going to affect your valuation? And delighted to take on the topic. The only caveat I gave Jay is that's about a 20-minute presentation. And with all the activity we're seeing with our clients, can I broaden the topic a little and spend a fair amount of time just talking about what we're seeing with people and how to get ready to do acquisitions? And so that's what you're actually going to get today is a little broad-based, a little broader based than we started, but hopefully you'll find it interesting as you're thinking about if you're making acquisitions as such. Specifically what we will cover today, start with what I was originally asked to do, sort of the how making an acquisition may well affect your valuation for ESOP purposes. Then I'm going to start to put yourself in the company thinking about an acquisition and some of the things you should be doing as you get ready for an acquisition, if you want to get started or you want to get restarted if you haven't made an acquisition in 5 years. And just sort of get yourself in the frame of mind of, okay, what should we be thinking about and doing to get in an acquisition mode? Then we'll talk for a while about sort of the specifics, the mechanics, and some of the planning opportunities that you'll have while you're in the process of making an acquisition. Hopefully we'll talk a little bit about some of the mechanics and valuation thoughts that you may be having, or at least I'll encourage you to have while you're in the process. Finally, we will hit a couple, we'll hit a couple of ESOP specific issues. There are a number of things that are very unique about ESOPs making acquisitions. And then last but not least, hit a couple of the things that we've seen our clients do for better or for worse, and some of them are better and some of them are worse, of lessons learned in the post-mortem, if you will, from the acquisitions folks have made. Start a little bit with the effect on valuation, if you will. Before I get into the actual mechanics of how we might look at evaluation, I did want to just sort of offer a couple of practical tips. And the first one is I do sort of encourage you to talk to your appraiser as you're in the process of. I think if you start, do this while you're buying a company, you'll get some interesting, you'll get some interesting perspective. One, it'll eliminate surprises. If you talk to your appraiser and say, here's what we're thinking about, hopefully they can sort of start talking to you about, well, here's what we would anticipate it being. And quite frankly, it's not bad priming the well of, here's why we're doing this, here's the cash impact we expect of doing this, so that they can understand. If they understand, there's a lot better chance of doing a smooth integration when you add a business. In any event, it'll eliminate the surprise of make an acquisition, get to the end of that plan year, give the acquisition data to your appraiser along with, and then, oh, here's what the valuation means. You're going to get a lot more interactive, a lot less surprises if you talk your appraiser through the process as such. The other thing I think you'll find is talking to your appraiser and most of you, and all your advisors for that matter, as you're getting ready to do, is it should help you do a better job making an acquisition. If you start to talk about, here are the things that we hope to get out of an acquisition, let your advisors brainstorm back with you. What about this? What about this? Have you thought about this? You know, there are just lots and lots and lots of things to consider in an acquisition, and getting those thoughts in up front or while you're in the planning stages you're much more likely to have a good outcome in your valuation if you're thinking about these things on the way in rather than 60 days post-mortem after you've done an acquisition. And so from the standpoint of even just doing a better acquisition, if you will, as such. And obviously, hopefully, talking to your advisors and your appraiser in particular should help you get a sense of what value maybe you should be paying as such. And you'll understand, okay, you know, here is what I'm seeing as your appraiser is likely to happen with this. That should tell you if you're paying too much, if you're getting if this deal works, if the cash flow works for you. Good discussion up front will just help you do a better acquisition and sort of help you set your expectation of what is that going to do for our valuation, and rather than just here it is at the end of the first year afterwards. A couple of practical tips we've seen in actually doing valuations for all of our clients that have made acquisitions. And I sort of have one interesting theory about value when you're buying a company, and I guess I'll say the day one. Oh, can you put Barry? Beth, when I talk about the valuation company, I would suggest it's your appraiser as such. The folks you are used to working with. If you're working with an M&A firm, sure, they can help. If it's the other side's M&A firm, you're not going to see it. I'd be dumbfounded if you saw any part of their valuation work, or it'll be the puffery they want to put into the valuation. Rather than, I apologize, I'm talking about your advisor networks, the folks you have confidence in, the folks that understand your financials and what an acquisition might do to your financials. Great question. Back to my effect on valuation, and I'll call it Dave's theory about day one. One, normally, unless there's some interesting strategic synergy that you're getting out of the valuation, you're buying a company. If you spend $5 million to buy a company, they're a willing seller, you're a willing buyer, neither under compulsion to buy or sell, and both having knowledge of reasonable facts. That's the definition of fair market value almost verbatim. So there's a pretty good odds that unless there's some synergies or something, the minute after you buy a company, it should have no effect on your company's stock value, because hopefully you got $5 million of value if you spent $5 million for that company. And so literally the day one, the minute one value, absent some kind of major strategic synergy, is virtually zero on your stock value. I have to admit, even our clients that we've worked with over the years that say, yeah, we hope to get this synergy out or we hope to get that out, I tend to have a wait-and-see attitude, because you really don't necessarily know how an acquisition is going to work out until you get to work at it a while. If you do an acquisition within probably 30 to 90 days for sure, and even as I've done this for as much as 9 months after, I will tend to suggest the treatment at the end of the valuation year. There's a real practical one, and that's, let's say you bought a company on November 30th and you're at December 31st valuation. I literally like to sort of undo the transaction, if you will, i.e. you spent $5 million, you have either $5 million of cash you no longer have, or you have $5 million of debt related to the acquisition. I will make an effort to carve out the acquisition's results from your consolidated results that you have at the end of that year and just add the $5 million back until you get a chance to see how the acquisition works under your ownership. I tend to just like to undo it, if you will. And I've done this for as much as 9 months after a deal was done as such. literally just carve it out. You probably don't even, if it's 30 days old valuation, you may not even have a good projection for the next year to include it in a discounted cash flow. We'll start, the longer my clients have owned the company, I'll tend to head for what I call a split treatment at that point. And that's where if you've owned something for 9 months or even 12 months, we probably will include the results of your acquisition in a future discounted cash flow. Hopefully if you own the company 9 to 12 months, you'll have a budget for it for the following 12 months. And if we're doing a discounted cash flow and income method, we can include it and include the debt or the cash that's gone because of the acquisition in your discounted cash flow. And it should flow pretty smoothly if you've been, if you've owned a company for even 6 months, but for sure 9 months and 12 months. Hopefully that works its way into your forecast, into your budget, and you just bring it right into your discounted cash flow going forward. Sometimes for even a year later, if we're doing a multiple of historical earnings, a guideline method of one form or another, I still may do the carve-out method on that basis, carve the results of the acquisition out, and add the price you paid for the acquisition to that guideline company method. Mostly because even after a year, I only have a year of how your company will be, how the target will fit within your company, what its results will be under your management. And normally we look at 5 years of results, so the second year back, the third year back, the fourth year back, the fifth year back can get a little dicey in terms of trying to say what results they really had. They may have managed their income stream for tax reasons. They may have done a variety of things differently than you did. And so for a while it doesn't hurt to have, I like, in many cases I'll call it doing the split basis, including the acquisition in your discounted cash flow or income method, maybe carving it out in your guideline company method if you're doing one. But then after a couple of years, one way or another, you really have to, you should be lumping it in both. After 2 years, you've got 2 years of results. It should fit in your company. We should be doing it, including it in your discounted cash flow, including it in your guideline company. The one thing I will remind or sort of expect, try and get the company's results. You'll have them if you made the acquisition virtually anyway. But as an appraiser, I'm going to go in and try and adjust for their non-recurring items, their deal fees that the target incurred, any discontinued items the owner may have been doing prior to. If they had, any of their perks that went away, you'll want to add those back so that we really do add the benefit of the earnings stream you're getting once we start to incorporate it. And the last thing I'll say with that is virtually any time, whether it's in your expenses or theirs, you will tend to add deal costs back or deal fees or anything like that as a non-recurring item to your results the year you made the acquisition. Probably even to the target's results, their fees may have been just as much as yours, and I'm assuming they ran them through their income statement and expensed it for tax purposes as much as they could as well. So we will look at adjusting for deal fees and costs in our historical earnings for any guideline company method or capitalization of earnings method you might want to use. Last but not least, I do always have to remind my clients of if you're going to have a contingent payment and a year from now you owe $2 million of the $5 million purchase price based on the results. Well, if we're targeting those results in your discounted cash flow, we better target the cash outflow from the contingent payment in both of your valuation methods, because it's going to be a real cash drain on the company. And quite frankly, that's usually one where most of my buying ESOPs want that number to be as high as possible, because that means the acquisition's working as well as possible. But we do want to put it in valuation as such. Any questions about what else to expect in your valuation? These are sort of the pragmatic ways that we've done it a little differently for various clients depending on fact-specific circumstances, but usually it's going to fit into one of those kinds of opportunities.
Hey, Dave, this is Jay. I have a quick question, Dave.
Sure.
In virtually all of the cases that you're involved with, are these acquisitions remaining as separate operating entities for quite some time and therefore have separate financials?
There is no norm to that. I have everything from something that's a product line acquisition that gets tucked in as fast as it can to companies that are 1,000 miles away and will run as separate entities. And actually for the accounting, then you're going to have to count the goodwill if it is a separate entity. But I can't say there's a norm to that. It's all over the board. There are, lots of companies that, I had one client that bought somebody that was literally 1,500 miles away. It's a separate division. It's measured separately. We have some others that merge them in, and they get mixed in the soup just as fast, and it no longer is a measurable entity anymore. So
right.
It's all over the board. It's very fact specific and very company to company. Geography probably plays as big a role. Synergies also play a bigger role. If it's if it's a competitor, if it's someone in your business line, you're going to try and roll it in as fast as you can to make it one seamless entity at that point. Versus if it's a sort of a nice complementary product, but it's 1,000 miles away and they do something different than you, it's going to stay an independent entity.
Right.
Foreign ones tend to stay separate entities just because of the reporting and the foreign income tax considerations, for example.
Thanks.
Okay, next I want to talk about getting ready for acquisitions. And this is, if you're thinking about acquisitions, the first thought for anybody that wants to, start, okay, we're going to make an acquisition, the first thing I'm going to tell you is get ready to kiss a lot of frogs, because I've heard investment bankers talk literally in the sense of, you will hear about 100 companies for sale. You may get, sort of teasers or 1-2-page outlines for 20 companies and start to snoop for every company you buy. And it really is the type of thing where this is buying companies is work, and therefore want you to get in a frame of mind of it's going to take some time, it's going to take some effort. I have one company where they, 3 years ago promoted someone to COO, and the CEO's job for the last 2 years has been about 40% of their time making acquisitions, and they've made 3 acquisitions in the last 24 months. So it's going to take time. It's going to take some money to do this. It's going to take some effort. You're not going to sit in your office and find too many acquisitions just fall in your lap as such. So, the takeaway from that is get ready to have somebody or somebody spend a little time on this if you really want to get into buying a company or a couple of companies. The where to look is sort of my flip comment to that is everywhere. The more targeted is, here's what we've seen clients with success. We actually have 2 clients that have had really good success working with a buyer's agent. One of them, the buyer's agent, I think is in Fort Wayne, Indiana. The other one was in California. Both of those are Midwestern companies that were making the acquisitions. I think it came down to, that was a function of they worked with those folks because there wasn't as, it did take some of their time off it, and also gave them, when they gave the buyer's agent sort of a decent outline of what we want, here's our company strategic plan, here's what would fit in it, go bird dog for us, and they brought back the 20 prospects, and then, literally in some cases you're going to go Google SIC codes and find out what comes up for various companies, or Google keywords, or to find out where the companies are, or what they are. Try and find out anything you can about them to come up with a list of 10 or 20 qualified, I'll call it prospects, it still may be suspects at that point. But a buyer's agent, and it's hard to find good ones because lots of investment bankers say they do it, but most investment bankers want to sell your company, not help you buy a company. It's a contingent payment. It really is kind of a weird, specialty niche in the world. The other thing, I guess, the other places are back to the everywhere. Are you active in your trade association? If you're, folks that you're meeting there know you're a growing company, that you've bought companies. Who is 64 years old and active in the trade association and doesn't have a son or daughter in the business? All of a sudden becomes an interesting prospect that you might want to learn more about them. Do you talk to your advisors, your professional advisors, your lawyers, your accountants, your appraisers? Everybody ought to know we have money and we're looking for a targeted acquisition. The better insight you give them into what you might be looking for, how it fits, is it a cousin of what you're doing now? Is it a, what you're looking for? And it's hard because you're going to say what you're looking for, and they might not, they're going to find something that's in the neighborhood of sometimes. But at least sort of let them know, here's our strategic plan, here's what fits in our parameters of our strategic plan. Don't be afraid to tell people you're out looking, whether it's the trade associations, professional advisors. Quite frankly, CEOs, CFOs, go network with the local M&A community. There are investment banks in every major community around, and there are small business brokers, and there are major firms that like to do $100 million deals. Go get to know them and let them know who you are, because if they land on something that might fit you, I guarantee you'll get the teaser about it at that point. The other thing that's interesting about that is a number of them are, I think you'll find most of them like to show off, and most of them will tell you how they do deals, and I think that can be highly valuable for most folks that are thinking about deals to learn. I had one situation where I arranged a meeting between some M&A folks that I know and one of my targets, and he threw out a, geez, I know so-and-so, and they're not for sale, but they sure look like an interesting strategic fit to you. Do you want to go talk to them? And it never did wind up my client buying them, but they wound up getting a supplier out of it. It was an interesting, they wound up getting a business relationship struck out from talking to an M&A advisor. And as I said, they didn't buy a company from it. But these are folks that are out making things happen. They get paid to go make noise and be movers and shakers in the community. So having breakfast once a quarter with 5 M&A advisors or once every 6 months is not a bad thing if you're trying to make acquisitions. And last but not least, don't be afraid when you're at the OEOC conference to let people know, gee, we're a dynamic company and growing. In the ESOP world, don't be afraid to tell your peers, because you never know where a lead is going to come from. And it's going to take a lot of effort to find those leads. Next, I want to talk a little bit about, okay, let's talk about your company a little bit more. And when you're thinking about an acquisition should be part of your overall strategic plan. And I have a number of clients that are pretty good about this, actually. They sort of know what they want to acquire. And they have it in their business plan. They also know how much money they can spend because they don't want to have an acquisition get in the way of some of the strategic things they're doing for their organic growth. But acquisitions become part of their annual planning process of here's what we're doing internally, and therefore here's what we can be looking at, thinking about here's what a good acquisition looks like for us. So when you're doing it, if you're doing an annual business plan, an annual strategic plan, just like capital expenditures, just like repurchase obligation, just like working capital, management succession, all the issues you'd put in your strategic plan. A new venture is not a bad thing if you want to start doing M&A. Put it in your plan so that you have the wherewithal, the time, the resources committed to do it. It'll also help you because you'll know what you're looking for, and you're not looking in the 4 corners of the world. You're looking in more a targeted area. I will also suggest to start looking for strategic fit when you're looking at target, and think about what that fit really is. What will fit in your business model? And that can be, I had one client that really liked to say they either had to know the product or know the market before they'd even touch something, because otherwise they were incredibly naive going into a business. So they wanted to know the end market they were selling in. If they knew the end market, they might, okay, we don't have to know how you make the product. Or if they knew how to make the product, they didn't necessarily have to know the end market, but they wanted to know one. Another of my clients said in no uncertain terms they want to stick to their knitting. They want to understand, at least reasonable amounts of the business they're buying so that they just don't totally blow an acquisition. It reduces risk significantly the more you know about the product or the market you're buying into. The last bullet there under strategic fit, I have to say, is values. And that is, one, is your culture ready for an acquisition? Because that means you're in a growth mode. That means, are you ready to be? Are your people ready? Because they're going to start reaching outside their 4 walls, and your sales force is all going to suddenly have some new folks to play with and to talk to and or maybe to integrate with. So is your culture ready? The other part about it, when you're out there, look at the target's culture. Is this going to mesh with your culture, or are you just creating all sorts of chaos? Fit of a target can be very important as such. Not unlike if you were hiring a key manager or somebody, would you hire somebody that doesn't fit? Well, depending on how you're going to use this acquisition, you may want to look at how does this company fit for our culture standpoint. That all sort of in the strategic fit of what you're looking for, whether it's product, whether it's whether you know the market, how do they fit in your strategic plan? Even if you don't know either of those, can you integrate this? How is the company going to fit in your product? Next thing to think about for your company is your company ready for an acquisition? And quite frankly, this is a handful of things I put up there. The most interesting one really is, do you have the management I don't want to say the talent's probably a bad thing to say about it, more a depth thing. Do you have a management that's going to, is your management ready to tackle, okay, this is a whole new can of worms we're opening. We're going to have to go in, we're going to have to integrate, we're going to have to do a lot of things. Do you have the depth to park somebody from your management team in the target? And it's not that you want to run the target necessarily, but if it's a big enough acquisition, somebody from your company probably needs to go get parked there and to help them understand your culture and help them how they can integrate with you. If you're going to ask them to sell your product, it'd be nice if somebody were local to explain what it is, work with it. Or if you're going to sort of work with them, somebody that integrates how you work and how you function as an organization. Do you have the depth in your organization, whether it's somebody goes there for a few months, whether it's somebody goes there 1 week a month so that you can start to integrate? But there's going to be some time and real distraction from the management team, from your core business, and you have to have the time and you have to have the energy and the manpower or management level in order to do that if you want to be most successful. Other part about it is you really do want to sort of assess financial. And I was surprised because most of our 100% S Corps don't have this problem, or a lot of them have the checkbooks or have the war chests at this point. But I have had a couple of clients that sort of, okay, I'd like to do an acquisition, and it's like, that's fine. Don't you have to buy $1 million piece of machinery next year? And so you do have to look at the cash flow in the context of, do you have a high repurchase liability year coming in the next 2 years? And you got to have the money for the acquisition, but you also have to have the money for the core capital, the core working capital, repurchase obligation. You can't starve the core business, or you don't want to starve the core business in order to make an acquisition as such. And then within your management team, who's going to perform the due diligence? This is one, even though I've worked with a lot of clients on acquisitions over the years, I'm still not all that comfortable of what due diligence ought to look like. And therefore, most companies that have never made an acquisition are going to not know how to do it. And I'd like you, if you're thinking about an acquisition, start thinking about, okay, has our accounting firm ever done and most of them will tell you they have. Ask them for, okay, what 10 acquisitions have you done and who's done them that I should be having lunch with to brainstorm about, if we get close to this, who's going to help? Does your law firm know how to do it? Talk to other people in the community about who they've used. The M&A advisors who have they seen that does do good diligence. And once you've done 5 of these, you'll do it your own in your sleep. The first one is just really hard, and you want to be very prepared of who's going to do the due diligence, because that's sort of a key of making sure you're getting what you pay for. Any questions to this point? The one that very few people think about that I did as I was preparing for this did come back to me is the culture piece of this. And how are the two if you're buying a big company or sort of a peer-sized company, you do get into the thinking about the culture, and everybody thinks about the financials at that point. How are we going to play together is a very interesting question while you're getting ready, and it's the one that very few people think about. So that's probably the one, as I was going through my own presentation, I wanted to re-emphasize and get everybody to geez, how are we going to do that? Last thing that is kind of a sidebar that's very ESOP specific is your plan ready. And it's not that your plan won't be compliant. It's a little bit of, do you want to include people? Can you include people? Can you exclude people? Make sure you understand the ESOP mechanics of, I did have one client that bought a company and it was far enough away where they could test their way around from discrimination and not include them in the ESOP on a long-term basis. And from a culture standpoint, they were far enough away where it wasn't a problem. But sooner or later, if you're buying companies and you keep bringing 3 of their managers in to your 12-person management or strategic planning committee, and you keep talking about ESOP, 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 and the 3 of them go back to their plant and say, geez, it's a wonderful ESOP company, wish we had it. You do sort of got to think about, can we do this? How do we do this? And what does your plan allow? Even without testing, if your plan has like a provision that treats new employees are not eligible to join the plan for a year, if you buy a company on January 3rd, they're not going to get in until January 1st of the following year. And if you have a plan provision that says you have to be an employee at the end of the plan year in order to get an allocation, you can almost go 2 years before anybody's going to get an allocation of the acquisition, giving you a couple of years to figure out, do we want to include them or not, before they actually get some stock in the plan. You also may want to look at the standpoint of, I have one client that gives sort of vesting virtually at the end of the first year, very quick vesting. And I will politely say, that may work great for your culture and your company if you have very good long-term employees and nobody leaves all that often, or they leave in 6 months or they last. If you're buying a company that has higher turnover, maybe you want to go to the 3-year cliff or the 6-year staggered vesting because their culture is not your culture, and you'll want to have your plan ready to think about, okay, this just doesn't apply to us anymore. This applies to the new 40 or 50 newbies we're about to get as employees, and what do we want our plan to look like for them? So is your plan ready for an acquisition is another point on the as you're getting ready. Okay, any questions on planning process, thought process? I almost want to tell Jay to unmute you so I can hear if anybody's breathing out there.
They're breathing, I can guarantee it.
All right. It is the hardest part about doing a webinar versus doing a live presentation because I'm pretty much talking to my computer right now.
I think we'll open up the lines at the end, Dave.
Fair enough. Okay, as I said, let's shift over from thinking about it to doing it. And the first 2 here are what everybody think about. And everybody thinks about, okay, am I going to do a stock deal or an asset deal? Am I going to buy the stock of the company or am I going to buy the assets of the company? That one's a pretty easy. The one thing I really want to put out there for you is, can you just buy a product line? Some of the best acquisitions my clients have made have been product lines where, XYZ company has about an I can think of one example where someone had an $800,000 sales product line that my client probably knew how to make the stuff better than and it was a bastard child to the company that had the product line. They did other things. This was just something they'd picked up over the years, didn't know how to do. They didn't give a lot of marketing effort. It wasn't making a ton of money under their tutelage. I think my client went in and bought a company that had or product line that had $800,000 of sales. They knew virtually all the customers. In fact, they had a bunch more. They turned that $800,000 into about $1.3 million sales, and the company only made probably $150,000 of sort of pre-tax EBIT on that $800,000. And by the time they got the business up to $1.3 million, as I said, they had the capability of producing it already, brought it in-house, turned their sales force loose, and turned an $800,000 product line with $150,000 in sort of pre-tax income into $1.3 million product line for them in 2 years, and about $400,000 of EBIT. And so don't be shy about looking, is there a product line you can tuck in with your current sales force, with your current operations, if you will. You don't have to buy the whole animal, and by the way, the company may not be for sale, but it may have something that doesn't fit that is for sale. And so, yeah, you can think about buying company in a stock sale or an asset sale, but don't downplay the, geez, this fits nicer with, this fits better with us than it does with you. Would you like to sell? And we'll take the 4 people that are selling that product line, and that's really all we have to do, and we'll tuck it into our existing operation. So product line, we've seen that on a number of cases where it's an interesting opportunity, and not usually what people think about when they're doing an acquisition. The next thing I want everybody to start thinking about when you're doing this is the cost of the acquisition. And I put this slide up there. Okay, everybody figures out the purchase price. And then most of the time when you buy a company, you'll agree on a purchase price in fixed terms or some kind of relatively set term. And then you will have a working capital adjustment, because if their inventory and receivables jump for one reason or another between the time you start negotiating and the time you close, they'll probably ask you to buy that extra inventory and receivables or pay more in the purchase price. By the same token, if they bleed the company dry, collect all the receivables, let the inventory run down, stretch the payables out, your purchase price ought to go down if they dry the working capital out totally. And so most of the time deals are done with purchase price plus a working capital adjustment as such. Don't discount contingent payments. I used to do that and think, geez, nobody's going to want a contingent payment. But if you're working with, in the last couple of years, this has been particularly appropriate, because when my clients that were buying in 10 and early 11, they were buying companies that were coming out of the recession just like they were. And nobody really wanted to sell their company at a multiple of 2009 results. And so I know a couple that got done at the end of 10, they had 10 or 11 months of 10 results to do, but the sellers are saying, well, geez, 11 should be a much better number for this, and this reason, and they have. I had a client that did a $9 million purchase price, fixed price, but they had a formula in there that was going to pay out if they just continued what they were doing. They got, I think, another up to $2 million, and if they did better, there was a $3 million incentive payout over the next 2 years. And so, it's a little bit more tricky to get somebody to convince that you'll really pay them that money, or you won't screw up the income statement in the meantime. But if you are buying someone that's sort of got a couple new things in the iron that could grow significantly, nothing wrong with saying, okay, if this happens, we'll happily pay you more money if the EBITDA is $1 million more a year, 2 years from now than it is now because of this happens. But I'm real hesitant to pay it for ifs and maybes that haven't happened yet. So don't downplay the possibility of a contingent payment. Closing costs and time and that are not insignificant. I did have one client that sort of looked at it, it's like, well, I can afford to buy about $2 million a company. And then we sort of went and looked at, okay, great, $2 million acquisition. What are you going to do with that company the following year? And it's like, well, it should grow, and therefore receivables and inventory are going to be $500,000 higher. Okay, better count that in the purchase price, because you don't need $2 million to buy this business. You're up to $2.5 million. Closing costs are going to be between you're going to spend $100,000 to $200,000 on closing costs. You're up to 2.6 or 2.7. What are you going to do with the business after you acquire it? Are you going to have to not only the working capital, but are you going to buy a $150,000 machine to where when all is said and done, I have seen $2 million purchase prices become $3 million investments. And just like to make sure that that's in your frame of mind or frame of reference when you're going in of what, the purchase price is X, but what are you going to do with it afterwards can bump up your investment in the acquisition well above its purchase price. It's kind of funny because the example I gave you, that the $9 million price company that had the contingent payment, my client actually went in and spent $2.5 million on machinery for that company. I sort of was surprised because they wound up still having to pay contingent purchase price because the company obviously made more money because of that. But it was an interesting scenario. They weren't shy. The business was going to get that much better. Their EBITDA was going to get that much better. But I saw somebody invest $9 million, have a contingent purchase price, and still spend $2.5 million more on machinery and equipment, so that, you know, by the time they got their total, the total investment in the company was 9, 2.5 was 11.5. The contingent purchase price is another 3. That's $14.5 million is the investment in the company. You do want to think about that in terms of what EBITDA are we going to get out of this. It's one thing to say, geez, the EBITDA is going to be $2.5 million. We spent $9 million. That's a great turn. That's less than 4 times turn. By the time you're done investing, if that total investment is $14.5 million and your EBITDA is only $2.5 million, you might not like that acquisition so much. So I do want you to think about not only the purchase price, but contingent payments, cost, and sort of post-acquisition investment. And by the way, that investment can include the, if you have a $100,000 person that with travel costs are going to cost you $200,000 to park them in the acquisition, that ought to be somewhere in your modeling along the way. So that's the other. That's sort of thoughts about acquisition costs. I do want to say again, don't discount the possibility of contingent purchase price or seller paper. It is a lot better if this is the 3rd deal you've done with somebody and paid contingent money. If you actually paid it on the other 2, you got a lot better chance of making the target understand, yes, we really do pay this money out. And quite frankly, then you start looking at them as someone may offer more money down, but we know how to integrate companies. We've done 3 acquisitions, and in each of our acquisitions, we've paid the seller a nice contingent purchase price. Your offer may be better than an all-cash offer once you've gotten in the frame of mind of doing it, executing it, and showing that you really do know how to buy companies and get value out of them and help the seller realize some of that value through a contingent purchase price. Want you to think about as you're making an acquisition, knowing what you're buying. And this isn't so much the due diligence aspect, but it's just a matter of, are you focus on why you're buying the company. Are you buying a product line? Are you buying the assets because they have some unique assets? Are you buying another branch location where you're going to have, brick and mortar and feet on the ground? And yes, I've had a couple people make European acquisitions because it's just easier than trying to do a startup there. And by the way, they usually get some new product out of it and some other things. But are you flat out buying a new location in Salesforce? Are you buying the intellectual property? Are you flat out buying a company because it has some stuff that you can sell better than they can sell themselves, and you're looking for synergy? It'll help you focus on what you want to analyze when you're doing your analysis of the company. It'll also focus on what due diligence is important, because if you're buying the intellectual property, then boy, you want to make sure no one else can use that intellectual property. How do you protect it? If you're buying an organization because it has a strong people base, do they have non-competes in place? Will they walk out the door the minute they go? If you're buying it for the European location or the brick and mortar location, question from Barry. Jay, is that an active or is that an old one?
That's an old one. That's been there. Yep.
Okay. Will what are you going to be able to keep that infrastructure in place? Are there enough customers out there, or are you going to park more business out there? It'll help you figure out what the due diligence process you want when you understand, I'm buying this business for this and this reason. Here are the critical things. There's going to come a time when you may not care about, if you're buying intellectual property, as long as no one else can use it, you may be buying a product line, getting the intellectual property, bringing it in-house, and not worry so much about do the people fit, because they're not going to be around 60 days later or a year later. Or the sales force has to fit, but the manufacturing folks don't, because they're going to stay at the current company and keep doing their job, making the other things along with what they're making for you. And by the way, if you're buying a product line, what kind of manufacturing agreement do you get with the current manufacturer to make you a nice supply of it until you figure out how to make it yourself? All those things will help you do better due diligence, will help you draft a better purchase agreement when you sort of focus on knowing what you're buying or why you're buying a company. Due diligence, I wanted to put this up just to sort of give everybody here's a couple things to think about. I can't spend a lot of time on this because this could be a 2-hour webinar in and of itself. Whether the one I will talk about probably more than anything is management. Are you buying a management team? And if you're buying an existing company, the team that's running the place is critical. If you're buying it because it's a product line and you're going to take it out of there, don't worry about it. But if you're buying a division and want to run it as an independent division 1,500 miles away from your location, focus a lot on management, because that's who's going to make you money going forward. And if they're not there, you're going to have a real problem, getting the value out of your acquisition. The other things here are more along the lines of other things you'll think about. And as I said, I could spend, or you can do a 2-hour webinar on getting into the sausage of due diligence. It's a lot of work, but I'll focus on a couple other things since we're down to about 15 minutes left. A couple of quick bullets. Once you get there and sort of figure out what your due diligence is, you will want to have a plan. I had a client that was kind of fun watching them go from their first acquisition to their second. Their first acquisition, they really didn't quite do as good a job on due diligence because they didn't think about a plan. Here's what we need to check out. Here's how we're going to do it. The second acquisition they made, they had a plan. They knew exactly what they were going after. They knew how the financial analysis. They also put a team together. They got their marketing guys in to see what their marketing challenges were going to be. They brought in their CPA along with their CFO to go over and scour the books of the various things they wanted to look at. And so, set a plan and prepare a team when you get ready to make an acquisition. And if it's a $500,000 product line acquisition, that may not be as important. If it's a $10 million acquisition of a remote site that you're going to operate as a remote business, really do want to put a lot of your team in place. And by the way, putting your team in place as part of the due diligence will go to great lengths to helping you integrate a business, because if 5 or 10 of your people are in the target, they're going to get to know your marketing people, get to know their marketing people. Your finance people get to know their finance people. You'll have a lot better feel for how's this going to work later and how are we going to fit together later if your team's involved. In making an acquisition, you can get a lot into the X's and O's. What all of my clients have told me is they wanted to do, when they're doing value for, they're going to do multiple valuation methods. They're going to look at a multiple of earnings, multiple of EBIT, a multiple of EBITDA. They also do discounted cash flow. Now, if you're doing a discounted cash flow, be realistic. I have seen more than one client just assume their way into a number that made no sense whatsoever, because, oh, gee, we can grow here, we can grow here, we can grow here, we can grow here. And it's like, maybe. You can assume your way into a pretty unrealistic value if you're not careful. By the way, if you're buying a business in 2013 after a strong 2011 and maybe strong, maybe solid 2012 and in the middle of a decent 2013, when's the next recession going to come and what's that going to mean to the target that you're buying? Don't assume that you're buying the company in its best year ever and you're going to grow at 10% a year forever, because you're going to overpay. You have to maybe throw a recession in that DCF model and be very careful about DCF. So, think about that when you're doing it. Don't be afraid to run your DCF by your appraiser, because they're going to tell you, particularly the first or the second time you're doing it. Every time I've done this, I've given my clients my DCF model with a fair warning. I'm giving you a loaded gun, and if you don't use it well, you're going to shoot yourself in the foot. And most of the time, they've given it back to me and said, okay, critique this. And we've had fun. And if you're 100% S Corp, you're putting a 35 or a 40% tax rate in there, even though you don't pay it, because no acquisition will look bad if you don't. And you will pay way too much for an acquisition if you don't. The other part about that, get back to my question of what are you buying? I'll be a little mean right now. Do you have to pay for it? I've had a couple clients that looked at distressed companies, and I know one that's bought that got involved with 2 distressed companies. They bought one because it was there were some very good reasons to buy it. Quite frankly, they let the other one go. And 9 months later, it went out of business, and they went back to the auction and picked up the equipment they wanted, and they never saw the customer list, but everybody in the industry knew everybody else, and so they just started banging on the customers' doors, and they could have paid another half to $750,000 to buy the company while it was in trouble, and it was a very high note. It may seem a little harsh, but your job is not to bail somebody else out of bankruptcy. Your job is to take care and grow your business. And therefore, it was very interesting to watch letting one go. And then what are we going to do with it 9 months from now? So I do also like to ask why people are selling. Most people say we don't care, and to a degree I agree. It is nice when you're talking about, does this business fit us? It's nice to at least know that the owner is selling because of X, Y, Z reasons, and that sort of fits your culture, that fits your values. Or you got a problem if it doesn't. At least you know what you're getting into. Versus if you're buying someone that's in a succession mode and doesn't have the successor, well then you better go put a management team in place. It will help you assess fit and help you assess how to manage a business if you understand why somebody's selling. They may not tell you. Here's an interesting thing I learned a long time ago. And Jay, I don't know if you were in the session at the ESOP Association when they did this long ago and far away. Had a guy come in to talk about merging, and they were talking merging organizations, not merging companies. But his comment to me was, put your value statement and your mission statement up on the table next to your targets. And if the values are consistent, you have a lot better chance of fitting together. You really do want to think about it. If their values are similar to yours, there's a pretty good chance they're going to fit with you. They're going to you'll play nice together if everybody plays by the same rules. By the way, you still better do due diligence, because I've seen more than one company who didn't follow their values very well, or put values up on paper because they were told by an outside consultant they needed a value statement. And then there's the other side of the equation. If your values don't fit, doesn't mean you might not buy the company, but it does mean you get ready to go in there and change everything overnight. You do not expect to let them run as an independent entity for 3 years if their values are totally different than yours. You want to go in and make the changes you're going to make quickly, or you're going to have their values conflicting with yours and their business philosophy conflicting with yours. If their values are different than yours, just go in with an attitude of, okay, we're going to change what we think we need to change, and we're going to do it quickly. And so I like putting a value statement up. 1, you'll know if you got a fit. 2, if you don't, you'll deal with it much quicker and drive value out of that acquisition a lot faster than letting 2 cultures that butt heads with each other coexist for 2 or 3 years before figuring out we need to do something.
I would say it's a great point, Dave, really a great point. It's relatively easy to measure EBITDA and quantify the financial side of an acquisition, but it's not that easy to, quote, measure the culture of the target. So you have to allow time for that.
And it may be you're going to flat out put your culture in there, but you better have the management time to spend on it. You better have the resources to spend on it. Just know what you're getting into. If it's not a fit, you got some more work ahead of you. If it's a fit, hopefully it's a little less work integrating the two. A couple of ESOP specific points as I'm rounding third and heading for home. We mentioned a little earlier. Do you want to bring NewCo's employees into your ESOP? Can you exclude them? Are you prepared to test? Do you want to bring them into all your benefit plans as such? The second one here is fun, and I've had a couple clients, I've taught a couple clients, and I've seen them do it to their advantage. If you're a 100% ESOP company, can you use that tax benefit to your advantage? And here's where I've seen it done. Had my client was competing against someone else buying a company. The other company is a 100% tax-paying entity. They came in and bid $10 million for the assets of XYZ company. My client did enough legal homework, or said we were willing to think about sending our lawyers in there and doing enough legal due diligence that maybe we'll buy stock. And in this case, it was a C corporation that had a huge built-in gain, and by the time the owner got to spend the money for the $10 million asset acquisition, there was only going to be $6 to $7 million left to distribute to the owner because of built-in gain taxes and other things. So my client went in and built, I can't remember if it was $8 or $8.5 million for a stock deal, and went and did the legal due diligence and were comfortable. There was not, and basically they didn't care about writing up the assets for future depreciation. They're 100% ESOP. And so think about the deal in the context of if you're 100% ESOP of, can we get a better deal if we do a stock deal, or even if it's an S corporation that doesn't have the built-in gains, do they have a huge depreciation recapture, because there's been bonus depreciation for the last few years for most people. And if you're buying a company that has $5 million of assets that's written them off to zero, if you're buying the assets, they probably have to write those fixed assets back up to $5 million and have a high level of tax on depreciation recapture. You might even just agree to a better asset allocation model because you don't need the depreciation, and that may be the differentiator between you and someone else, because you'll agree to say those assets are only worth $2.5 million. The other person you're competing against may say, well, geez, I think those assets are worth $4 million, and in the purchase and sale agreement, the target's going to have depreciation recapture at a higher rate than capital gain in their transaction, and you're a better tax treatment. So don't ignore the tax consequences and assume normal tax rates in any DCF calc you're doing. Quick last piece. Some of the lessons learned. First one I love is start small. If you've never made an acquisition, I'd encourage you not to do the $10 million one first. Do the $1 million one. Do the product tuck-in first. Get your feet wet on due diligence before you make a peer-size acquisition, because just the cost of being wrong is pretty ugly. I did have one client that their first acquisition was $2 million, and 2 years later he was a little grumpy about it, because in this case CEO, CFO looked and said, we only should have paid $1.6 million. And it wasn't a fatal error. They still had the business. It was still doing okay. It was still generating cash. But they learned a lot on their first acquisition, so that then they went after the $5 or the $7 million next. They were a little smarter about doing it. Next one is plan on looking what, and hopefully, Jay, you're not going to yell if I go over about 5 minutes, because my clock says 11. But I'm down to my last page of bullets here. So,
go ahead.
But plan and model what the target looks like once you own it. One, I hope it's worth a lot more to you than it is to them. Because if you think you're paying $10 million and that's all the company's worth, you're probably going to uncover some negative surprises once you own it for 6 or 12 months. And so I'm hoping you're buying companies that you think are worth 13 for 10, so that when you really do get to see the baggage that they have, and you see the warts a little up closer owning it for 2 years, you still got a good deal. The other reason you want to model it like you're going to look like, are you going to have to put your health care in there, and is that a different cost structure? Are you going to put your ESOP expenses in there? Are you going to put your XYZ expenses in there? And all of a sudden, the company whose EBIT you were buying is an independent company with no health care plan, no pension plan, stripped down bare bones XYZ that made $1 million as an independent company, only makes $500,000 when they're part of you. You might not like it so much anymore, and I'd like you to know that, if you make the acquisition, I'd like you to know what you're getting up front. Model it like it's part of your company. One of my CEOs, when I was going through this, I sent out an email to a couple of them. They said, big one, plan on getting the value. Know why you're buying the company. We're buying this because we're going to do synergies. And therefore, the minute even during the due diligence process, your target may understand why you're buying this, so that your people can go in there and say, we're really going to get this. And so it'll help your due diligence. It'll help you day one when you acquire. Here's what we're doing. Here's the value we want to get as a merged company. You're ready to go. You're out of the gate. You're getting value as quickly as possible if you're planning on how you're going to get that value. Here's a weird one for you. Don't ask for all your due diligence up front necessarily, and here's why. Let's say you think you want to buy a competitor. It's the logical thing. They're retiring. We can get rid of this. We can get synergies. All these good things. So normally you put out a nice little due diligence, and they give you a list of employees, they give you a list of customers, and a whole bunch, and then they make you sign a non-disclosure agreement. Well, how about if you don't get that list of customers up front, or don't get that list of employees up front, and you start looking at the financials and you see an environmental liability, or you see this, that, or the other thing that makes you run for the exit after the first thing of due diligence you've gotten. If you've gotten their customer list and if you've gotten their employee list, you can't go back 6 months later and start calling all their customers, even though everybody in the industry may know all these customers already. You're the one that you may be the only party that's excluded from calling on them because of your sort of non-disclosure, non-compete that you're going to sign in order to get due diligence. So think about, don't get all the due diligence until you've peeked under the rug a little and know you really do want to go forward with this. Figure out which are the last ones you may want to ask for, because if it falls apart early, don't penalize yourself compared to your other competitors that may want to call on the customer base and you know who they are. Last thing a couple of my CEOs did is I sent this outline to them. I'll call it a smell test. At the end of the day, you can't be afraid to walk away from a business and let your smeller test. If you've gone through all the due diligence and on paper it looks good, but for some reason your smeller just says, I don't like this. I don't have a good feeling about this. Even if you can't quantify it and can't say it, if you have a bad feeling about something, it probably is a bad outcome and you probably should be heading for the exit. And it's going to be hard because I don't want you to get too invested in a deal. As a CEO, it's going to be very hard if your CFO, if your head of marketing have been working on a deal for 6 months and spending all their time doing a deal, and you get to the 11th hour and say, this doesn't feel right. They're invested in it. They want to do the deal. They've gotten, they know it, they own it, they like, even if they're skittish about it, they may be afraid to tell you, no, we shouldn't do this. You can't be afraid to walk away. Let your smeller be the judge of, this is a bad idea, folks. Let's head for the exit. Yeah, I know we've spent $250,000 on due diligence. $250,000 on due diligence is way less than a $6 million acquisition that's bad. And by the way, not only is the $6 million acquisition price bad, figuring out what you do with a bad acquisition and all the management time and all the pain and agony it's going to cause you while you're figuring out what to do with that bad acquisition for the 3 years until you actually sell it. The pain is just let your smeller and be your guide. Have a good smell test. Don't be afraid to walk away at the last minute. And the last thing a lawyer taught me about 25 years ago is don't pick up the last nickel. If you're down to 11.2 million or 11 million, or 11.1 million or 11, if you're not willing to concede and give the seller the 11.1 million, don't do the deal. For 2 reasons. One, odds are everybody in the company is going to see you were that sort of nasty, hard-dealing SOB that went after every nickel, and everybody in that company is going to be afraid of, is that how we're going to run this business? That we are penny pinchers, we're not going to, and by the way, normally most of the time the owner stays on for a year or 2 to help you transition a business. And if you absolutely went after every nickel and were a Scrooge and were, conned them out of their last nickel, if you will, how much enthusiasm are they going to have versus putting a contingent purchase price in there and winding up, if it works well, paying them a little more? So from a positive standpoint of keeping the folks that you're working with happy to help you make money, if it was worth 11 and you don't think it's worth 11.1, go away. The other reason, if you're not willing to part with that last nickel, by the time you actually get in there and see the company and see all its warts, if you're negotiating so hard you have to get that last nickel or you don't want the deal, you don't want the deal. You're going to find way more than a nickel's worth of warts when you get inside the tent and own it for 2 years. Other questions, comments, thoughts? I've rattled through a fair amount over the course of about an hour and 5 minutes with a fairly broad topic base.
Dave, great information. I'm really glad we did this. This is you've given a lot of really useful information in an area that would have tremendous potential for any company, but especially an ESOP company, and especially an ESOP company that's 100% S Corp. Okay.
100% The ones that are 100% S going forward are just getting to where they have the wherewithal, whether it's I have some that have multi-seven-figure cash positions where they're looking for something to do. Have some that have paid down their debt, and the banks are, in this day and age, the banks are banging on their door saying, we'll lend you lots of money at LIBOR plus nothing.
Right.
And so it is an interesting opportunity. The only caveat I guess I put on in 2013 is deals aren't probably as cheap as they were in 9, 10, and 11, but your cash position may be better. Back to my first comment, you may have to kiss a few toads to find something.
Exactly. Well, we're running out of time, but real quickly, I'm going to open up the lines here in just a minute because I know you want to know whether there's really human beings on the other end of this call. I have a quick question, though. Back to considerations regarding the way our plans are written. Could there be pass-through voting to the trust participants' issues, either based on your plan or by ESOP law?
Possibly. I mean, if you formally do a merger, that is a pass-through voting event. So if part of your transaction includes a merger, you're going to have to pass that through. Most of the time, if you're buying a company, if you're buying, one of the pass-through ends is selling substantially all the assets. It's not buying substantially all the assets of a company. So if you incorporate new co-subsidiary and buy the assets, that's not a pass-through item. If XYZ company buys the stock of ABC company, doesn't merge the two together, you just run it as an independent sub, it's not a pass-through item. You don't get into the pass-through until you actually want to do a merger of the companies, which may be immediately and maybe a year later, and you have time to educate your employees about it. You probably want to try and avoid it while you're doing a deal because you get the deal closed and figure out how to merge it later, and rather than having to give notices for mergers for the pass-through voting requirements for ERISA.
Great answer. Good. Thanks.
The conference has been unmuted.
Okay, everybody. Let's let Dave know that you're out there. Any questions?
Yeah, my name is Ralph Anderson. I'm calling you from New Mexico. Can I ask Dave a question?
Sure.
Dave, Ralph Anderson, is there a chance to get a copy of your slides?
Send Jay an email and we'll see that you get what you need.
All right. Thanks.
Yeah, you can do it either way. Following this presentation, you will get a feedback email, and in the body of that feedback to us, just let us know that you would like a copy of it and give us your email address. Or right now you have Dave's slide up in front of you. Dave, they can reach you at that email address, right?
Absolutely. If you're in front of your computer and want to send me an email real quick, we'll get you a copy of it out.
So either way. Either way. Good. Any other questions?
Thank you. Please stand by.